there's only one reason why gold is at $4,000. It's the U.S. bond market. By using debt, we put our country at risk. We crossed the Rubicon. There's no fixing this. Gold, it only makes these big moves when the stock market is having trouble. And the stock market hasn't had any trouble yet. So the big moves are ahead of us. My targets are 6,000, 7,000, 8,000, and I think 6,000 is fairly easy. Now the question is, what's going to stop it from going like above 8? When you get that 8x return, what is the rug pull? And I think that rug pull is the reset.
Don Durrett, precious metals analyst, as well as founder of goldstocksdata.com. It's a true pleasure to host you on Palisades Gold Radio today.
Thanks for having me on, Stijn. First time.
Excellent. Excited to hit the ground running, Don. And talking gold for a second, I believe you recently foresaw a correction in gold. Of course, we have now seen a move from about $4,400 an ounce to about $3,900. Was that the move that you foresaw?
Yes, but I didn't think it would be this deep without the S&P rolling over. So yeah, I mean, you have to always expect around a 10% correction in gold, even in a bull market. If you go back to 2004 to 2010, the average every year was about 10%. And we didn't get through a single year during that bull market. So gold was up, I think, around 600% from that in that period. So it's up almost 100% every single year for like 5 years, 6 years. And every year, even though you had those big moves, 50 to 100%, you had a 10% correction every time. So the bottom line is this, is that gold and silver are going to be volatile. You're not going to get a free ride. It's going to be hard. You're going to have to hold on. And so, yeah, I was telling everybody, expect a 20 to 30% correction in your portfolio, which is what we had. Gold actually fell 12%. It kind of more than I expected. I thought 8% was kind of where I was going, 8 to 10, but it went from 43.71 to 38.86, 12%. Silver went down 18%, 54.46 to 45.50, almost $10, $9 drop in silver, top to bottom. It has bounced $2 since then. And then the HUI was down 22%, 693 to 552. It's now bounced 20 points to 572. So that was about a 30%, 22% correction in the HUI. That's the large cap. So for the average gold and silver mining portfolio, it was down at least 25%, probably 30. So I would say around, so we got our 20 to 30% correction. The bad news is, hopefully people are buying this dip. The bad news is we got another one in front of us. We're not going to be able to fade. I'm expecting the S&P 500 to crash. We can talk a little bit why I think that's going to happen. But if the S&P 500 is going to crash, our miners are going to get hit again. So I actually think we're going lower when that happens, but I don't know when it's going to happen. It could be weeks or months. But I think that if we could go down, the gold could go all the way down to 3,700. That would be a 17% correction from the top if we don't go back to the top. Hopefully we'll go up a little bit here before we correct. I don't think we're going to go all the way back to 43.71 and then correct 17%. But that's kind of worst case. I think 3,700. I'm thinking it's worst case, but maybe it's always things can get worse than you expect. Silver, I think, could go to 42. That would be a 26% drop from its recent high. And the HUI could go down to 500, which would be 32%. That means your portfolio would go down 40%. That would be brutal. My portfolio went down 70% in 2008, but it all returned, and I was up 100% in 2011. So even you can have a 70% correction, so even if you go down 30, 40%, you can get back healthy fairly quickly in a bull market. And so, yeah, so this correction was absolutely expected. They're normal. But in a bull market, and I believe this is a bull market, I said it would take 4 to 8 weeks. but this is deeper than I thought. This might take 12 weeks before we actually get back to an all-time high. We'll see where we're at the end of the month, and then we'll see where we're at the first of the year.
Understood. I would love for you to zoom out for a second, really. What is driving this bull market in precious metals, and whether this bull market is still roaring, in your opinion?
Yeah, I love the question. The reason why gold is going higher is only one reason. And this is where people, they don't realize it's that simple, because that one reason is complex. And so they can't really connect the dots. But I've connected them, and I always knew it was only going to be this reason. And now everybody's starting to figure it out, and everybody eventually will figure it out. But that one reason is the U.S. government bond market. It's literally the only reason gold's going up here, the only reason. So if the U.S. government bond market, let's say that the U.S. government had a budget deficit of $100 billion today, and had and inflation. I'm not bringing inflation. I'm only talking about the bond market. So if we had a $100 billion deficit right here, we could handle that easy peasy. Our bond market would be strong, and nobody would be worrying about us paying our debts off, the ability to pay our debts. And the U.S. economy is the number one economy in the world. It's about 23 to 24% of global GDP. I heard Trump say today that 75% of profits of pharmaceutical companies came from the United States consumer. 75% global profits. So America is the kind of the grill in the economic system, if you will. And if that system is basically dying before our face or before our eyes, you need some type. You start to get nervous about what would be the ramifications if the U.S. bond market failed, and you got to run for cover. So right now, since 1945, U.S. Treasuries. I mean, if you were a student, if you were a business student or finance student at any college, they would tell you that U.S. Treasuries are the risk-free rate. That U.S. Treasuries are risk-free. That's what they teach you in school. Risk-free, right? So around the world, countries have been holding U.S. Treasuries as their reserves, thinking they're risk-free. But when you have a $2 trillion deficit and you have $100 trillion in unfunded liabilities, suddenly that bond market doesn't look so stable and solid anymore. It starts to look fragile. It starts to look unstable. And that instability is the reason why gold's going higher. It's because people are going, I don't really trust these treasuries anymore. The Chinese stopped trusting our treasuries all the way back in 2013, and nobody even noticed. If you look at the chart of Chinese treasury holdings, in 2013, it was $1.5 trillion. They were number one, 1.5 trillion. Since then, all it's done is go down and down and down. Now it's about 750. They've sold half over 10 years, 12 years. They've sold half, and they continue to sell. And that's wise. They're like, we're kind of idiots here. Now, isn't it interesting that they started selling after the U.S. economy basically broke? They saw it, and anybody who was looking could see the U.S. economy broke, and nobody's kind of paying attention here. The gold is the canary. Gold is telling us that, but the bond market is the heart of the U.S. economy. It's literally the heart. If you want to kill the economy, you kill the bond market, because that bond market it funds all the liquidity in the system. It basically. The U.S., for instance, the U.S. government, we have $2 trillion deficit. Those transfer payments, if you don't have those transfer payments, the U.S. economy is dead, right? So it's the blood that flows in the system. That bond market is the heart of it all, and that bond market has basically been failing, and it started failing in the year 2000. So if you go through the 1990s, the U.S. could basically generate growth in a kind of a capitalistic system, where the Fed was on the sidelines. The Fed's budget was like the balance sheet was like $250 billion. He's like, it was a little thing, right? Because they're like, we don't need to help you. You guys are doing fine, right? And then it went all the way to 9 trillion. That's when it broke. It was like it told you. But when the dot-com bubble busted, the U.S. economy could no longer stand on its own 2 feet, if you will. So we had to start living off of debt. So debt exploded from $5 trillion in 2000 to $38 trillion today, growing at $2 trillion a year. So again, there's only one reason why gold is at $4,000. It's the U.S. bond market. It's the only reason I got into gold and silver, because I knew that eventually it's going to break. You can't do this. I mean, I have an MBA. When I went to business school, and they tried to tell me, that debt was good and that the U.S. bond market is free, and I'm like, they don't teach Austrian economics, Keynesian. I knew, back in the mid '80s that what Reagan was doing was wrong, and then George Bush Sr. came out and said, "This is voodoo economics, people," and nobody even had said anything like that. But I was like, he's right. What he said, yeah, that's 100% correct. This is voodoo economics. The Austrian School of Economics is the only school that makes any sense. Sound money and no deficits, and you generate wealth. Otherwise, you put your country at risk. And that's what we've done here by using debt. We put our country at risk. As a matter of fact, we crossed the Rubicon. There's no going back now. There's no fixing this. And the bad news is, and I've been telling people, we lost our country. We lost it. It's gone. Now you can say, oh, don't bet against America. We'll fix this, Don. America's got this, this fantastic, history, the Constitution. Well, guess what? We don't even pay attention to the Constitution anymore. That's a clue for you that we're done. We ripped it up. I mean, look at the Patriot Act. They ripped it in two. Free speech. Who has free speech anymore? That is the First Amendment. That's gone. So the clues are there, but it's all about the bond market.
Today's episode of Palisades Gold Radio is proudly brought to you by our parent company, Palisades Goldcorp, Canada's leading junior resource investment vehicle, trading on the Toronto Venture Exchange under ticker symbol PALI. With equity and warrant positions in over 200 companies, ownership of mineral projects and royalties, and a 15% stake in newfound gold, Palisades offers investors powerful leveraged exposure to precious metals, uranium, copper, and other critical minerals. Palisades shareholders directly benefit from our team's extensive industry knowledge and access to deal flow, opportunities historically reserved for a small group of investors. To learn more, visit us at palisades.ca and join us in our mission to level the playing field for investors. Now, back to the show. Well understood, Don. You mentioned earlier on in this interview that you think the S&P 500 might roll over, and that could cause an even deeper correction in precious metals. Why do you think so?
Because I really like the way that Jim Rogers lays it out. Jim Rogers says that if you think that it's different this time, that the business cycle went away, he goes, I got news for you. It didn't go away, people. Be very, very concerned about the state of the economy, the state of the stock market, the fact that we haven't had a deep correction, deep recession, basically since 1982 was the last one we had a deep one. So we've been manipulating the heck out of it, but we've still had these recessions. Plus, we had the last recession we had was 2008, but it was manipulated out. It was over in 9 months because they lowered rates. They basically used the Japanese model. They basically said, we'll just copy those guys. We'll just print like crazy and lower rates. And it worked. But it was not a solution. That's not how you fix things. So that was kind of they actually created a bubble out of that. So we just got out of the housing crisis bubble in 2007-8, and then they created this everything bubble right out of 2008, where they started printing money like crazy and taking rates to zero. The Japanese model, the MMT, modern monetary theory, and Jim Rogers is like, these older guys, Jeremy Grantham, It's like, you got to pay attention to these guys who've been around. They've been doing this since the 70s, some of them in the 60s. Warren Buffett, $350 billion in cash. These guys have been around the block they know that the business cycle didn't go away, people. These bubbles do pop. They do know that the Austrian economic model makes sense. That, what von Mises said, that if you create a bubble, you only have two choices. You either pay off the debt, which we can't, or it pops. Those are the only two options. Now, you can say, well, we can just keep kicking the can down the road. Janet Yellen said, we'll never have another recession in my, I don't know, she said her lifetime or forever. Okay, so you got the business cycle. The business cycle didn't go away. We will have a recession. It's going to happen. The question is when. So then you have to start looking at the data, right? The data. Why are we not in a recession, and how are we leaning, right? So the reason I think we haven't had a recession was twofold. The first one was the massive immigration from Biden. Those immigrants, they just flooded into the country, but it actually created GDP because they either worked or the government printed a whole bunch of money and gave them a bunch of money. It created a lot of liquidity in the system. And I think if we wouldn't have had that immigration surge, if you will, we probably would be in recession already. Now that surge is over, and so that's kind of sucking the wind out of the economy. And then you had this massive, the so-called fiscal dominance thesis, which I think holds water, which is the government printing massive amounts of money liquefies the economy and it kind of puts a floor under it and kind of keeps it going, right? We're seeing slow degradation. We're seeing, for instance, housing. Housing has kind of hit a wall, which is pretty obvious to everyone. It's right. It's like if you're trying to sell your house right now, it's getting more and more difficult to sell it. That's kind of a clue that the housing market is kind of in a recessionary territory. And probably going worse, right? That's pretty obvious. And we got the labor market, which kind of broke late spring of last year, and continues to deteriorate. We're seeing more and more layoffs. And then the banking system itself, so they have this ugly balance sheet where they have all these bonds that are underwater. They continue to buy more of these bonds that basically are not really economic. Then we're seeing more delinquencies. We're seeing delinquencies in auto loans, mortgages. Mortgages not as much, but auto loans are definitely trending up. Credit cards are trending up. Retail sales, I think, are a challenge. Restaurants are a challenge, where cost of living. So we're seeing signs everywhere of weakness, and then the last thing that has happened in the last 3 to 4 months has been these bankruptcies by these private investment, private banking, the private credit companies. These companies that were giving loans to all the immigrants on those auto loans, and the immigrants went home, and then they all went. We've had 2 of them bankrupt, and I think a third. So that could have reverberations. So, but I'll take it back to where I started with the Jim Rogers and the business cycle. I just think it's long in the tooth, and we're just when these things roll over, they roll over. They have a life. They kind of have a life of their own. You don't know when they're going to start. They just start, and so people right now. And the other clue, which is kind of obvious to anybody that's watching, right, is the stock market. You got the 10 companies in this S&P 500 make up 40% of the value. 490, right? It's like it's way overweight, and then those 10 companies are the vast majority of the earnings. If you kind of look under the covers, the stock market isn't nearly as strong as it appears, and it's way overvalued. The Buffett index, that's the reason why he's in cash. It's 200% of GDP, way overvalued historically. PEs are, kind of in nosebleed areas, way overvalued. And so you just add it all up. What does it tell you? It's like, this isn't, I'm calling this, but it's worse than that, because this has been building for 30, 40 years. I'm calling this the Humpty Dumpty crash. And when this thing goes, there'll be nobody putting the pieces back together, sadly.
That case is definitely well made, Don. Thank you for taking us along in your reasoning there. Definitely understood some short-term volatility we might see in the stock market and therefore also in precious metals. I would love to, again, zoom out a bit and talk about what type of targets you are foreseeing at the end of this bull market that we're in for both gold and silver. I would love to hear your reasoning behind why you think those targets might occur.
Yeah, so we have to basically look at history to get an idea of kind of where gold's going, right? So in gold, it only makes these big moves, right, when the stock market is having trouble, and the stock market hasn't had any trouble yet. So the big moves are ahead of us. As a matter, and so that's a scary thought. That if the big moves are ahead of us in gold, then wow, what does that mean? Because gold's already at an all-time high. So in the 1970s, we went from $35 gold to $850. I mean, that was the mother of all bull markets in that decade. And basically, that is when the U.S. mercantilistic system died. 1970, 71, 72, and from 45 to 70, we had a mercantilistic economy, which is the best economy you can have. You know, that's when you have a one parent, you know, not a one parent, but a one worker household. One person could basically pay for the house and the cars and everything. That ended in, you know, like 1970. And so 1970s were a total mess. We had two energy crises. We had inflation. You know, we had the malaise of the Jimmy Carter years. It was ugly, right? Gold did fabulously well. So then the next problem was 2000 to 2011. That was an awful decade for the economy. That's when we had, you know, the housing bubble, we had the great financial crisis, right? So we're getting ready to enter that again. But if you look, that one, so the first one, you know, 850 divided by 35, that one was absolutely incredible, like 15x or something. And then the next one wasn't quite, it went 250 to 1900. So that's about 8x, something in there. And then this one, you could say the bottom's 1,000. So if you do 8x, it's about $8,000, $9,000, somewhere in there, which is where that's my expectation. So I think my targets are 6,000, 7,000, 8,000, and I think 6,000 is fairly easy. I'm very comfortable getting to 6. Now the question is, what's going to stop it from going like above 8? When you get that 8x return, what is the rug pull? And I think that rug pull is the reset. And I think that's when the bond market dies. And so the bond market becomes, you know, dysfunctional. People are like, well, how does the bond market fail, Don? They just print money. Well, there's your answer right there. If you print money, you destroy the economy. You create hyperinflation. You can't just print at will. There's a certain limit. And if the foreigners basically say, we're not only not going to buy your debt, but we're going to sell your debt, that's when it's game over. And so I think we'll get a reset somewhere around 7,000, 8,000 gold is my expectation. So that's about as high as I go. I go to 8 because I think that's when the reset happens. And so once the reset happens, you can throw everything out the window. We don't know what comes after that, as far as, you know, what gold means to the economy, what currencies we're going to use. The whole thing is going to get thrown upside down when that reset comes.
And Don, what about silver in this case? I think the case for gold is very clear.
Gold is very clear. Gold. So we had this 12% correction. I think once the stock market corrects and gold gets that next correction, I think after that, I think gold just trends until we get the reset without any serious corrections other than maybe 5 to 7%. And I think those corrections will be short-lived because I just think the demand for gold is just going to be enormous. So gold is a very clear-cut, understood scenario. Silver, not so much. Gold is the metal in astrology, metaphysics, if you will. Gold is the metal of the sun, and gold in the sun is masculine. It's like the sign of Leo, and so that is, you know, the alpha male, stable, you know, gold, right? And so there, but silver is the metal of the moon, which is the feminine, which is the woman, which is unknowable, which is you can't control, which is, so you can't understand silver, right? You can't understand a woman. So, that's kind of what you get with silver. So you don't expect an easy ride with silver. It's going to be volatile. It's going to frustrate you. It's not going to be an easy ride with silver. Now, the first thing that's going to happen with silver is we're going to have shortages. And when we have shortages, you're going to get massive volatility, massive. I mean, we're talking about going up $20 and up one month, $20 down the next. That could happen. And now you're going, well, Don, how could it go down $20? Now, I get it going up $20 in a month because of a shortage. That makes perfect sense for me. But how could it go down 20? Well, think about it. If we get a shortage and corporations are out there, Sony, Apple, they're saying, we can't find any silver. They're going to make phone calls to their, heck, Trump will probably get a direct call from Tim Cook. We can't find any silver. We need help. So that's going to happen. And so governments are going to react. And whatever. And so what governments, whatever, we don't know what they're going to do. They have lots of choices. But whatever they do is going to basically, in the near term, is going to make silver crash. So it'll go down. The miners will get just absolutely whacked. But it won't be a solution because there's only so much silver out there. And if gold continues to trend higher, which it's going to do, silver is going to follow it. So even if they crash it, $10 to $20, it doesn't matter because it'll go down there and then it'll just start coming back up. But then it can happen again. So then we could have shortage number 2 and they do something else and whack, it goes back down. So I'm expecting at least one of these rug pulls, and we could have 2 of them. And then here's the other thing is you could get rug pull number 1, and then it could start to come back up a little bit, and then they could immediately do rug pull number 2, and it goes down further. So silver is not going to be easy peasy to ride this thing to the top. There's going to be some rug pulls, but like I said, the rug pulls is in a bull market. They will not. We're not going to have. The only time that silver crashes and stays down is when gold crashes and stays down, and gold's not going to do that. Gold is going to keep going higher and higher. So they can try to split these things apart, but silver will turn around. So I call gold big brother and silver little sis. And so little sis just hangs back and she waits until the big brother says the coast is clear, and then she comes running. And so they can try to get little sis out of the way, but little sis is going to keep her eye on big brother, and she's going to come running. So even if they do these rug pulls on us, just be patient. Silver will come. Little sis is going to follow big brother.
Love the analogies, Don. I would love to talk about your framework for investing in miners, because I think what is really interesting about the way you view them, I believe, is that you look at future prices of gold and silver rather than looking at a conservative case and trying to be conservative with your valuations. You're really going for the upside potential that these miners have.
Yeah, it's the reason I got into this. I mean, I'm the only guy that really has been doing this. Now, I think there's a few people that are starting to catch on to my thesis. So when I got into this, believe it or not, my thesis from day one was that the bond market's going to fail. And if the bond market's going to fail, because it's inevitable, gold's going to win. Gold's the winner here. So, and it's not only going to be a little winner, it's going to be a big winner. So is it going to be a big winner? If I'm going to value a gold miner, I'm going to buy it low, and I'm going to wait for the bond market to fail, and I'm going to sell it really, really high. So if I'm going to sell it really, really high, I got to use a future gold price. And so I've always done that, and people everybody's like looking at the first 12 months. I don't care about the next 12 months until gold basically breaks out. So once gold, let's say gold, because gold, we're still early innings here, so I don't care about the next 12 months. But if gold, once gold gets above 5,000, at that point, I'll probably care about the next 12 months because I'll probably start selling. But until gold breaks out, until I get to an area where I'm starting to sell, again, this is a one-time trade for me. This is a one and done thing. I'm going to sell all my miners. This is the one thing about gold and silver mining is a terrible business. It's absolutely terrible because you find a mine, it only has a mine life of certain years, and it's really hard to replace. So it's a brutal business, but it goes in cycles, and so you can basically wait for those up cycles and make a lot of money, huge alpha basically, and that's the way I've always looked at it. I remember when I first started writing for Seeking Alpha, they used to push back at me because I was the only guy writing like that, talking about 5 and 10 baggers. They'd make me remove baggers from my article, going, you can't look at that. And then I haven't looked lately, but about a month or two ago, I was rated #1 on Seeking Alpha because the miners have been doing so well because I expected all the articles that I wrote, these stocks had been just ripping. So now they finally have given me a bit of a rein. They allow me to, they haven't turned my articles down anymore. They started accepting them. But when I first started doing it, man, they used to turn them down. That stock's too risky, Don. You can't, no. And I'm like, it's not risky. You can speculate on it because if the silver and gold prices go to the moon, this stock's going to the moon too. So it's all about correlation. You correlate, but it's not easy. I mean, it takes at least 2 years to really understand how to analyze these mining stocks, which in some respects is kind of advantageous to me because Wall Street doesn't know how to analyze these stocks, so they ignore them. It just absolutely cracks me up. I mean, when some of these stocks, when they're trading so cheap and you just know, like when Newmont was at $30, and why weren't they buying Newmont stock hand over foot? I mean, it's like, you guys do realize that you're going to make a boatload of money buying Newmont at 30. You do realize that, don't you? And they're like, no, we don't know that. So for me, when Newmont was at 30, I was telling people, just buy this thing to the bottom. Well, guess what? It barely went below, when I said that, it barely went below 30. We had a 29 handle, but I think it was above 29.50. It didn't go much lower than that. But to me, it was like so obvious that was either, that was really, really close to the bottom. And it wasn't going any lower than that. It was just, these sell-offs sometimes are just obvious. But my target was $300. So I was at, a 9-10 bagger for Newmont. That's pretty darn big return. So if Newmont was going to be a 9 or 10 bagger, you can imagine what these mid-tiers or juniors are going to be. So if you have a portfolio, the one thing is, fantastic about these miners is if you go up 100%, you're up 100, and then you double again, you're up 300%. You have a 3-bagger if you just double and double again. Then if you double again, you have a 7-bagger. So you double, 7-bagger. We're still in that area still. I mean, we're literally still, that's the kind of upside these miners still have. We basically haven't really went nuts yet. But if you're going to get a 7-bagger from here forward, you got to be a really good stock picker. I mean, but 5-bagger from here is very, very doable. And the ETFs will get you a 3-bagger. You can buy the ETFs today, they'll double and double again. So the first double is going to be 1,000 HUI. So we're right now we're 572. I think we might go down to 500 though. Go to 1,000, and these are HUI is the large caps, and then double again to 2,000. I'm expecting that to happen for the HUI. Now, the key is going to be how high gold goes. Does it get to 6,000? Does it get to 65? The key is going to be that. But that's my target. 1,800 to 2,000 on the HUI. So I'm valuing. I've always valued them. So when I first started my website, I was using $100 silver back in 2012, and everybody was laughing at me. And now we're like, we just got to 55. Another 100% moves $100 silver. So now my target is 125 to 150 silver. So if you take $5,000 gold, well, and you use 2%, which isn't that much. We were at 6% in 1980. If you do 2% of 5,000, you get to $100 silver. 2% is not that much. That's what it should be, 2%. We're currently just a little over 1%. You take $4,000 gold at 1%, it's $40 silver. So we're just a little over 1%. And I believe we're going to go somewhere around 2.5 to 3 when this is all done. But if you just use 2% silver, 2%, you go to $6,000 gold, that's 120. You go to use 2.5, it's 150. And these are not. This is finally I can say this out loud, and it's not crazy talk. It's like, no, this isn't crazy talk. You just look at the gold price and just throw a percentage on there. 1%, 2%, 3%. We're going to go somewhere in that area. And trust me, we're already above 1%. We're not going back there. So, I mean, 1.5 is just, if you're using 1.5, you're just not paying attention. We're going to 2, and we're probably going to 2.5. And so I'm using 125 to 150 silver as my targets. My website's still at 100. I need to update it. I'm using $5,000 gold, and I need to push that up too. So I'll probably go 125, 6,000, my next update. If you use those numbers, there's not a cheap silver miner out there right now. They're all 5-baggers. They're all 5-baggers. It's kind of crazy. All of them. So if they're all of them are 5-baggers or better, the average for the silver miners right now is probably 7. So if you only bought silver miners, if you just focused only on silver miners, you probably get that double thing that I'm speculating about. But the problem with only doing silver miners is that you might not have the belief or the mental makeup to handle it, if you will, because most people, a lot of people that get into this stuff, they don't have a ton of income still coming in, right? And so they only have so much. They've been building their wealth for years. So let's say they have 100 grand, 200 grand, right? They stick 75% of that, 50% of that into silver miners. And that's their net wealth. And then we get one of these rug pulls. They can't handle it, right? And then they end up losing money because they're like, okay, I'm down 25%. I can't handle it anymore. I can't go down 30%. I can't go down. I got to sell everything. Right, and that's the risk here. It has potential huge alpha, but it also has potential huge volatility that the average person can't handle. And so you got to realize that even though I'm very bullish that we're going to see these high gold and silver prices, $5,000, $6,000, $7,000, $8,000 gold, even though I'm uber bullish and very confident that's the outcome here. Remember my underlying thesis. My underlying thesis is that the bond market is going to fail, right? I could be wrong about that. I'm betting the house on that. I'm betting everything on that. That's many people would call that a Six Sigma event. Now I think it's a fait accompli, but I can be naive here. So I'm a speculator. You have to understand that. Gold and silver mining is speculating. This is not investing. Anybody that you could go down, we just saw it go down. Your portfolio just went down 30%. we just saw, this is not where you just make money. Now, if you're a trader, that's a whole different animal. Traders trade day to day, week to week. That's a different thing. What I'm talking about is speculating for the long term, for the big money, for the big alpha. That's highly risky. And I always say this when I write my disclaimers on Speaking Alpha. This is not investing, people. This is speculating. We are speculating that silver prices and gold prices are going to go higher. That's what we're speculating on. If they go lower, you could go underwater. It's easy. I was down. You ready? I was down 70%. 70. How many people can handle that? Right? So get ready. Be ready. I always say the bull's going to buck and the bull's going to run. And when the bull bucks, you got to hang on tight. And when it runs, you got to hang on tight. So before I created my website, I wrote a book. So in 2004, when I started investing in juniors, I couldn't find a book on the subject. I remember sending an email into Bob Chapman had a weekly show on, one of the few guys, and he read my question on the air and he said, this investor wants to know where he can find a book on how to invest in junior gold miners. Bob goes, sorry, kid, there isn't any. Next question. So, and there wasn't. I mean, I bought a few and they're just total junk. There was nothing. So I learned how to do it and I wrote my book. And so my book, chapter 10 of my book, basically lays it out. How to analyze stocks and how to find a 10-bagger. It's right there in chapter 10. But before we get to chapter 10, I explain it's basically a textbook. I mean, it's thorough, it's detailed. It explains how not only to analyze each of the categories, the majors, mid-tiers, and explorers, but it shows you how to understand them as well. Like all the little things that you need to understand and know. And so to find a 10-bagger, it's different for a producer, an explorer, a mid-tier, or a developer, and an explorer. Each one's different. You have a different approach for each one. So if we just look at development plays, for instance. So development plays, I use a checkbox. I use 6 different things. And so each one of those, 1 through 6, you basically want to rate each one like 1 through 10. And ideally, you want all 6 of those to have an 8. And if all 6 of them have an 8, one of those 8 is the upside, and you only want a developer that has 10-bagger upside. And how do you identify 10-bagger upside? Very simply, you take the current market cap and you compare that against the estimated future market cap based on future price, future cost, and future production. Very simple, just an estimate. So you estimate it out. If you can't estimate a 10-bagger, then it doesn't check the box, right? So you want to check all 6 boxes. So the way I've been doing it for years and years and years is I find these companies that check all the boxes and I buy them. And I just, I'm more of a collector. So what I try to do is I try to buy as many of these that I think have potential. I never try to pick winners. You can't pick winners in mining stocks. And I'll tell you a little story about why you can't pick them. But what you can do is you can pick potential winners and you sit back and you wait to see which one the winners are. And so I try to get as many of these, potential winners I get my hands on. And then I allocate according to risk reward. So if the risk reward, if it has a ton of risk, it's not going to get very much of my money. If it has fantastic risk reward, it's going to get more of my money. So that's how I allocate around risk reward. Now about picking stocks, I've been doing this for a long time. You never know which companies are going to do well. I mean, some of them have better odds than others, but the stocks that do extremely well, those aren't the ones you thought were going to do extremely well. So much can change in the mining business. The biggest thing that changes is acquisitions and discoveries, and you can't predict that. Can't. You don't know when a company's going to make an acquisition. Like Core Mining was trading like under $3. I think I got down almost $2, and they looked like a total dog. But what people didn't realize is that they were a shark. That that was a stock you had to own. There's certain companies you just have to own them, and you don't own them because of the next 12 months. People are like, I'm not buying that stock, Don. It was like down at $2. I created this list called the Mormon list, and it's up, I don't know, like 300% after it created. It was 8 silver miners. And I basically said, you got to just buy them all, sit back and wait and see which ones are the winners. And so back then, I think Core was it got down to like $2 at one time. I created this in like November of 23, and we just came out of a correction in November of 23. So you're pretty much buying the bottom back then. Well, anyway, people are like, I'm not buying that stock. It has a lousy balance sheet. They have high costs. They have a lousy management team. This is what people are saying, not me. And I'm like, no, that's not why you're buying it. You're buying it because of the potential it has. Now, why does it have potential? Number one, the location of their properties. Number two, which is almost as important as location, is the potential free cash flow. That's what you're buying, the potential free cash flow. But there's a third thing you're buying. And the third thing you're buying is the fact that it can grow three ways. It can grow through developing an existing project, a new discovery, an acquisition. Well, actually, there's four, and an acquisition. So there's three ways for them to grow the production. And if they grow production, the sky's the limit. Well, guess what Coeur did since then? They made two acquisitions. And who could have predicted that? Nobody. Well, me, because I consider them a shark. I thought they would do a deal. So they acquired Mag Silver, which completely changed the whole tone of the company. And it went from $2 to $18. It's a rip city. Just from that one acquisition. And then they just acquired New Gold, which made them even a stronger company. So they're now producing 900, after the deal closes, they'll produce 900,000 ounces of gold and 20 million ounces of silver. Pan American, which I consider the elite in the silver space, they produce 750,000 ounces of gold and 20 million ounces of silver. So Coeur just got bigger than Pan American. Now, how do you predict? Who predicted that, right? And so, if you're picking winners, you know, people are. I'm going to pick winners. I'm going to try to go for the next 12 months. You know, that's really not speculating. You're just trying to make money. Really, you're just all you're doing is chasing what's currently in favor. Oh, the miners are doing well. I'm going to go buy some of these stocks, and I'm going to focus on making money in the next 12 months, kind of thing. That's not what I do. I'm in this for the prize. I'm in this for 6,000, maybe higher gold prices, and 100, 125, 150 silver prices. I'm in this for the prize, so I'm, buy these things low, and that's what you do. You buy low, and then you don't even think about selling unless the story changes. If the story doesn't change, then you wait. You're very patient. You ride this thing to the top, and you get out. Like I already started creating exit prices for a lot of these. My exit price for Coeur is 70. So I'm in at 2, so that's a 35 bagger. Now, where can, and I think the risk reward was actually pretty good. As long as silver goes to 125, 100, I'm probably going to get my 35 bagger, which isn't a leap when you think about the current state of the U.S. economy. So where can you get that anywhere else? Nowhere else with that kind of risk reward. Now, it's 70 right now. I might increase that because they did the New Gold deal. I'll wait and follow them over the next few quarters. But if they start generating a ton of cash and they start becoming a monster company that everybody wants to own, I might hold it. I might change that to 75 or 80. I won't lower it. Because I'm not a trader, my emotional makeup. So you have to learn. Yeah, we have about 4 minutes left. You have to learn what your strategy is and what your mental makeup is as far as your portfolio, how much risk, and I talk about this in my book, how much risk you can handle, if you will. So I learned very early on that I'm absolutely lousy at trading and lousy at taking on risk. So I can't do a high concentration portfolio. I can't put 3%, in stocks, because then if you do that, you have to manage your portfolio, and you have to be ready to trade it on a daily basis, and you got to be on top of these. I mean, Rick Rule, he uses a concentrated portfolio. He talks about spending, an hour, at least an hour a month, I think, on a stock, something like that, maybe more. And he's right. If you're going to have a concentrated portfolio, you got to monitor those stocks pretty closely, because one stock can, hurt you. And so that doesn't work for me. I don't want to think about my portfolio. I want to take the emotion out of it. So what I found was what is my pain point. So if I invest up to my pain point, as long as I'm below my pain point, there's no risk in the stock. I literally do not care if that company goes bankrupt. and I've learned this over time, that as long as I stay below my pain point, which I found is 0.5% of my cost basis. So if I only go up to 0.5 of my total cost basis, there's no emotion. Now, if that stock goes from 0.5 to 5% of my portfolio, I don't sell and it doesn't bother me. I'm just riding on the profit. Now, there is some risk that stock could crash and burn, but my entry was very low, so it doesn't bother me that I have that. What I focus on more is the entry. And so my entry is 0.2, around average, 0.25 for very, very high risk, 0.5 for companies I like, and then companies that I really like, 0.75 and 1%. But not a lot of companies get 0.75 and 1%. Very few. And so by doing that, I own a lot of stocks. So right now I have about 161. I have another one I'm going to buy, so I'll have 162 here very soon. Plus I have 9 ETFs, so that's 171. So total 171. So I have a lot, and I'm basically I collect these stocks. But the ones that I collect, I believe, have good potentiality. They have a lot of potential. That's why I own them. And so I don't know how many of those are going to be 10 baggers, but I'm expecting at least 30, and probably 40 of those will be 10 baggers because I own so many potential 10 baggers. So I'm always going for alpha. So I don't really buy anything that only has like 3 bagger upside unless I think it's a growth stock. But I'm really 5 to 10 baggers, and I'm always looking for 10 to 20s. And then once in a while, I'll find stocks that I think have 25 bagger potential. Those are kind of rare ones. But even if I find one that I think has unbelievable risk reward at 25 bagger, it won't get more than 1%. It won't get more than 1%. Because like I said, you can't pick winners. Now the average person's probably going to go, they're going to put 2, 3, 4, 5% in that stock because they absolutely love it. They think it's a winner. And I'm always telling people, you're trying to pick winners. You realize that. No, I'm not. No, I'm not. Yes, you are. Yes, you are. You only do 1%. That's when you're not trying to pick a winner. So my website, goldstockdata.com. I'm not really a stock picker website. That's why it's called data. I provide data. There's like 850 stocks in my database, but if you own any mining stocks, it's a beautiful tool. And so I also rate all the companies, and I give lists. But what I'm trying to really do is create leads. Now, the one thing that kind of bothers me is people are using it as a stock picker site. So I have like a top 25, and I have these top picks, and people just buy those, and they don't do enough due diligence. And people can do whatever they want, right? But what I really want people to do is, okay, Don likes this stock. It's on his top 25 list. Let me go and look at it and see if I like it too. That's the whole point of the website. But it's very useful. Now, if you don't own any mining stocks, and you're going, man, this, I want to own some, right? Read my book. After you read my book, and you'll understand them, and then you can do it. I would say read the book first, then buy the mining stocks. But thanks for having me on, Stijn. This has been good. All right. I'll see you. Thanks.
This podcast is for general information purposes only and does not constitute investment advice, an offer, or solicitation to buy or sell any securities. The views expressed are those of the host and guest and do not necessarily reflect the views of the company or their affiliates. Guests on the show are not compensated for their appearance. Certain discussions may include forward-looking statements subject to known and unknown risks and uncertainties that could cause actual results to differ materially. Listeners should do their own research, consult a licensed financial advisor, and not base any investment decisions solely on the information discussed. For a full disclaimer, please visit our website, and for full disclosure and risk factors of any companies referenced, please see full available disclosure and risk factors on their SEDAR+ at www.sedarplus.ca.